We're now going to continue using ratios to understand final accounts. We're going to move on to gearing. This is my favourite ratio. What this will show you is how much money the company has borrowed in relation to how much it's worth. So basically, how risky is this business? It's a really insightful ratio that gets inside a business. So let's get on and find out what we need to do. We're going to find all the information on the balance sheet. So get your balance sheets. On the balance sheets, you need to identify equity or net assets. This can be called total equity as well. We're also going to look at non-current liabilities or fixed liabilities, obviously on your balance sheet as well. So in our example, I've got £200 worth of equity. I've got £100 worth of borrowing, and I need to find out how risky the business is. So I'm going to use the formula. I take the non-current liabilities, I divide it by capital employed, times it by 100, it will give me a percentage, which is my risk rating. So if you looked at the ROCE video, you know that capital employed turned up on that as well. So before we start, we calculate capital employed. What we do, we add our equity, 200, to our non-current liabilities, 100, that gives us 300. That is the amount of money the business is using to try and make profit. So we're now going to see what proportion our non-current liabilities are of that figure. So here we go. We take the 100 non-current liabilities, we divide it by the capital employed, 300, times it by 100 to make it a percentage, gives us 33%. So of the total money involved in creating profit for the business, 33% of it is borrowing. So 67% of it comes from the business. Now, what is 33 good? Is 33 bad? Look at this. A low risk business will have borrowed less than 30%. So our business here is pretty low risk. Medium risk, 30 to 50%, and high risk, 50%. Now, thing with gearing, thing with risk, if something comes along which is going to prove difficult for the business, this is its ability to deal with it. Can it borrow any money to get out of trouble? If a business has already borrowed 50% of its worth, it's probably not going to be able to borrow much more. Or if it does, it's going to have to pay really, really high interest rates. So a business with high gearing probably is going to find life a little bit difficult. So with Brexit on the horizon, you'd probably think, I'd rather have a low geared business, because we don't actually know what's going to happen in 2019. So stay with me, because we're going to continue and try and make it slightly more complicated. So we're now going to see how we can combine our gearing ratio with ROCE to help us make some decisions. Now we've got business number one, capital employed, £10,000, non-current liabilities, £4,000, profit, £1,000. Business number two, much bigger, capital employed, £100,000, non-current liabilities, £20,000, profit, £1,000. So if we work out our return on capital employed, I take my profit, I divide it by my capital employed, I times it by 100, I have 10%. So for every pound invested in the business, it generates, pound employed in the business, it generates 10p. That's okay. If we look at the second business, we take our £1,000, we divide it by £100,000, we times it by 100. My return on capital employed is 1%. Every pound involved in making profit generates 1p of profit. Not quite as good as the first one, but we're going to look at the gearing. So we're now going to work out how risky a business is. So the non-current liabilities is 4,000. The capital employed is 10,000. So 4,000 divided by 10,000 times by 100, 40%. Now that's bang in the middle of a medium risk business. So it's not high risk, it's not low risk, it's really quite average. If we look at the second business, it's borrowed £20,000. We divide it by the money involved, the capital employed of £100,000, and we find out it's got a 20% gearing. It is a much lower risk business. So the thing we need to think about is which business is the best investment? And to be fair, at this point, it's down to you. So if we think business one gives us a better return on our money, the 10%, but we've got a higher risk. Business two gives us a lower return on our money, but has a much lower risk. So do we go for the safe business with the lower return, or do we go for the more risky business with the higher return? I wouldn't be able to tell you what to do, but those are the things that you need to consider when we're combining ROCE with gearing.